Hi everyone, my name is Peter Pikalski. Today I would like to show you the final version of our delivery financial model. The link to download this model I will give you in the description of this video. Also I will give you all links to the process how I've created all this model. So you can go to the description of this video and see the whole process of creation. I will give you all the links. So our model is have the following structure. The first spreadsheet is the model itself with all the inputs, cash flow statement. Then the next sheet is a simple table with total revenues, total expenses, net profit and profitability. This is done monthly. The next sheet is the simple diagram, simple and discounted payback period, so we could easily see when our investment will go back. Then the next spreadsheet is where we set up the discount rate and search for internal rate of return. And then finally we have sensitivity analysis. In this block of inputs we can link a parameter to any input and test the financial efficiency, what will happen if for example revenue will decrease or expenses will rise, what will happen with simple, discounted payback period, net value, net present value, profitability index, internal rate of return and total amount of financing needed for the business. So what is the basic rule about our model? All inputs are colored with this specific color, this blue color, and today I will go through the model and show you what types of inputs you should pay attention to when you want to deal with this business, what parameters influence the amount of financing you will need to start this business. First of all, we just set up the first year when we start our financial projections. We have 10-year horizon, financial horizon in our model. And first of all, we just set up monthly the amount of customers that we have. So we set up this information. Then we say that we have, for example, 10 types of customers. And each type of customer has its own average check. So we divide all customers into different types. Then we say that, for example, 5% of our customers will have this check, 15% of customers will have this check. Then, for example, we can switch on and switch off different types of customers to see what will be the financial efficiency, what will be the simple and discounted payback period. If we, for example, we just take and switch off this customer and for example this customer, we can just switch it off. So using this table, using this simple inputs, we can create a huge amount of scenarios to what will be the financial efficiency if this happen, if that happen, if we are too optimistic with this type of customer, or we can not just switch on and off this or that customer. We can just say what will happen if we decrease the quantity of this customer, for example, to 30%. We'll have 70% of what we have today. It will happen with financial efficiency if, for example, we have not 100% of amount of customers, but we will have just 70% of what we've planned. What will be simple and discounted payback period. So we just can go here and see what will be the diagram. So this is very convenient when you have to create lots of scenarios to explain, for example, first of all, for yourself, for your investors, for your partners, um, and you can create lots of a huge amount of scenarios without retyping huge amount of data, huge amount of inputs. So this is very important for your scenario analysis when you create a cash flow statement, and you have to um, to see well, the result you see, well, you don't believe it, you just want uh, to create some stress tests, and this system of coefficients of switch on and off buttons, that it helps entrepreneur to see the clear picture of his business idea. Then we have the same coefficient that goes with average checks. We can do the same adjustment with average check. Then we have a very important parameter, distance to customer miles, because this will affect the fuel consumption, costs of expenses that go to fuel. This will affect the amount of cars that we need for our business idea. This means that it will affect the overall amount of financing, because it affects the amount of cars we need to operate our business. Then we can also adjust we can adjust using this coefficient the distance to customer in miles. So this is also very important when we just start creating different scenarios. Then we have overall coefficient that goes with all customers. For example, if we want to increase and decrease all amount of customers without adjusting this or that month, so you can quickly create different scenarios to see what will happen to the business if this or that occasion will happen with amount of customers. Then what we'll do, we have different types of customers, and we just describe their activity inside a typical week, because this will also affect the amount of delivery cars that we will need later. And we say that, for example, 20% of customers type 1 will order delivery on Monday, 30% of them will order delivery on Thursday, and for example 50% of them will order delivery on Sunday. And we can create different portraits for each customer type. So we just also, what we're fighting for, we're trying to calculate the real amount of cars, the real amount of investing that we need to start the business. So this is very important. Then we continue creating the system of limitations. So this is the system of limitations that allows us to see the real amount of cars that we need. So that this financial model is completely automatic, that we don't have to set up the amount of cars that we need. We calculated the Microsoft Excel, we create the system of limitations, and financial model calculates the amount of delivery cars that we need to operate this business. We just set up the amount of clients, customers. We just set up the distance to the customer. We set up when we have these or that customers. We set up the maximum mileage per day inside a typical week for the delivery cars. Also have a coefficient for that. And then we describe the delivery car fuel price, then fuel consumption, then we describe the maximum mileage when the car becomes old and we sell it, because all cars become old and the expenses will grow, the service expenses will grow, maintenance will grow. And if we look at this diagram, we will see these moments. So this is the moment when we buy new cars, and we buy them automatically. And if we have automatic algorithm for buying and selling new cars, we will more accurately calculate the amount of financing, the initial financing, and the financing that we'll need later when all delivery cars will become old. So here we describe when we sell the old car and buy a new one. Then we describe the price. By the way, all the inputs are imaginary. I'm just showing you the basic parameters, what parameters influence this business model. Then we describe the amount of drivers per car that we have. Then we describe the salary of one driver per month. Then we describe the insurance per car per month, unexpected costs per car per month. Then we describe the price when we sell an old delivery car somewhere in the future when it becomes old. Then we describe the maintenance expenses, service intervals. So here we just name different service intervals. Here we specify the mileage on the odometer when this service occurs. And here we describe what will be the cost of this service. And all these services will occur automatically when this or that mileage on the odometer will happen. We'll have these expenses. They will happen automatically. So, and we just we'll set them manually. So this is very important, because the more you do manually, the more mistakes you make. So to avoid this, we just create an automatic algorithm. We just set up the mileage, and then we set up the cost of this or that service, and this type of cost will occur automatically. Then we describe, if we have a loan, we describe when we take it, the year, month, the amount of loan. Then we describe the interest rate, the term of the loan, the grace period for the principal payments, grace period for the interest payments. Then we also have investment plan that deals not only with the purchase of the cars, but we can have some office expenses, initial and other initial investments. So we just have our automatic investment plan. So this is the moment when we have the first revenue. It is August, because August here is the first month when we set up the first customers, and that's why August appears here. And to the past from this moment, we specify what we invest in, how much we invest in, and when we invest in. So this is the investment plan. Then we describe the payroll. So here we describe the positions, salary per person in one position. Then we describe how many, from the first month of operating activity, we describe how many people on each position we have. So we can specify some dynamics. Also, we can specify fixed costs. So here we specify the item of fixed costs, and here we can specify the dynamics of this or that fixed cost item from the beginning of operating activity. Then we specify the revenue tax rate, profit tax rate, payroll tax rate, asset tax, how much we pay per month. Then we can see the cash flow statement. Here we can see how much equity we need with our loan, how much loan we need, and total amount of financing. So here we can see what is the net profit of our business. Here we can see how our business generates cash flow during all of our timeline. So here it is. So we can go through this cash flow statement month by month and see what will happen to the business in this or inside this or that month. We can click a plus to see the detailed revenue by this or that customer. delivery cars payroll, insurance, unexpected expenses, fuel expenses, and so on. Here we have fixed costs, so we can just push the plus button and see the detailed picture of our project. So now spreadsheet, we just have the total revenues, total expenses, net profit, profitability. Then we go back, we will see the financial efficiency, simple payback period, discounted payback period, net value, net present value, profitability index, internal rate of return, loan that we need to start the business, equity that we need to start the business, and total financing. This plus this. What is valuable about this model? For example, if we want to look or to dive deeper and see the influence of this or that parameter of inputs on financial efficiency, well, what we can do, for example, we can go to we have, for example, customer type 4, and we have an average check, and we would like to see what will be the financial efficiency if this check will rise or decrease. So what we can do, we can do the following. We can add a coefficient from sensitivity analysis, press enter, then we go to sensitivity analysis, and then we press sense. So using this instrument, you can link this parameter with any input. You can, for example, link this parameter with distance to customer. You can link this parameter to the loan. You can link this parameter to payroll, investment plan, to amount of customers. So any parameter of input. So also you can just, for example, the pace of adjustment. For example, here we have 10% of adjustment. You can change this value to 5, then press send button again, and sensitivity analysis will recalculate the impact of this parameter on financial efficiency. So this financial model allows you to look more closely to your business idea of a delivery business. So if you find this video valuable, you may give us a like, you may subscribe our channel. Also, you can share this video with your friends. We can create unique financial model for your business idea, for your existing business, to make you see the clear picture of it. I will give you the link to download this model in the description of this video. Also, I will give you all links to all videos where you can see all the process how I've created this model. So thanks for watching, see you next videos, thank you and bye.